Hello everyone, Bogdan here. Today I want to show you a very interesting trading model that can help you maximize your profits in the market and better understand how price actually moves. With this model, you will be able to stay aligned with the trend and clearly see the moments when the market gives a high probability entry opportunity. When that moment appears on the chart, you will recognize it immediately and be able to enter the position with confidence. This is one of the trading models from my Nightstar strategy. It works incredibly well when you understand the structure behind it, and I hope you will find this video valuable. Before we start, make sure to join my Telegram channel. The link is in the description and in the pinned comment below this video. There I share additional insights, trade examples, and useful materials. Also, don't forget to like this video, subscribe to the YouTube channel, and turn on notifications so you don't miss the next videos. Alright, let's begin. First, let me explain where this trading model is usually used and how I personally trade it. In my experience, this model works extremely well on the cryptocurrency market. Crypto is a very technical market where price often respects structure very clearly. Movements are clean, understandable, and when you learn to read them correctly, they can be very profitable. This model also works on Forex. However, on Forex, I usually pay more attention to session context. I analyze the character of the market during the Asian session and then make trading decisions based on how the market behaves after that. Of course, the same logic can be applied to indices and stocks as well. But personally, I prefer trading this model on crypto. For this specific setup, crypto is one of the most comfortable markets to trade. Now let's talk about the core idea behind this model. The main concept is that price first pulls traders into the wrong direction. For example, if we are looking at a long setup, the market will first create engagement into short positions. In other words, price encourages traders to sell. It creates the impression that the market is about to move lower. After that, we often see a sharp move upward. You have probably seen this many times. When you trade a classic structure setup, you see a swing break, maybe a test of a balance area or an order block. You enter a short position, expecting continuation to the downside. But instead of going down, price suddenly moves up. And at that moment, many traders start asking the same question: what went wrong? That is exactly what this model explains. Now let's look at the structure markup on the chart. Here we see how the highs and lows are confirmed inside an uptrend. In an uptrend, the high is usually confirmed first after inducement is taken. Inducement acts as a trigger or trap created by the market. In this model, inducement serves two main purposes: confirming the structure and attracting additional liquidity from traders. So what do we see here? Price moves down and takes inducement. That is the starting point of the whole structure. After that, the high above becomes confirmed. Next, we see the formation of what I call SMT zones. SMT zones are essentially trap areas. These can be blocks or imbalances where price attracts traders in the wrong direction and later takes their stop losses. First, we see a bearish SMT zone forming. After what many traders think is a break of structure, but in reality it is just inducement being taken, price comes back and tests this SMT zone. This could be an imbalance or a block, but the exact type is not critical here. The important part is that price reacts from this zone and moves down. At the same time, a bullish SMT block forms below. Price also reacts from this area. This is very typical behavior because price often reacts from these zones to create the illusion that a real move is starting. Then price breaks both of these zones and continues lower. Traders who sold from the upper SMT zone see a strong move in their favor. Their stop loss is usually placed above the previous high, and the target is somewhere much lower, so at this point the trade looks very good. However, traders who bought from the lower SMT zone are stopped out. Their stop losses become aggressive liquidity that the market takes. This is exactly what allows larger players to begin accumulating positions. After that, we see a sweep of an incomplete pullback. Earlier, we had a sweep of a classic inducement pullback, and now we see a sweep of an incorrect or incomplete pullback. This is an important signal that the market may soon reverse upward. In this model, these movements are often created by IFC candles. As you already know, an IFC candle is a candle that removes structural liquidity. Ideally, you want to see several sweeps in this area. First, inducement is taken with a wick. Then the low is swept again by an IFC candle, removing the incomplete pullback. After that, we get the engulfing movement that forms the IFC candle itself. Then we see a retest, and that is where the long entry appears, targeting the previous high. In my personal trading, I usually target around 1 to 5 risk to reward with about 1% risk per trade. That means roughly 5 to 6% return from a single position. But realistically, even a 1 to 3 setup is very easy to capture with this model. The Nightstar strategy, especially with the inducement filter and trend context, allows very strong entries. Of course, sometimes positions get stopped out. That is why experience and screen time are extremely important. But setups with 1 to 2 or 1 to 3 risk to reward can be taken very consistently, often with a very high win rate. So if your goal is to trade with high probability and solid risk to reward, this model can be a very powerful tool. Now let's look at a real chart example. This is actually a very good case. The structure here worked out in a very technical way, and it contains almost everything needed for a high-quality trade. First, we see inducement being taken. This is marked as number 1 on the chart. However, this inducement mainly acts as structural inducement. Its role here is to confirm the high above. The inducement that actually creates liquidity is the pullback slightly lower. It forms right before the IDM block. OBA-IDM is the first proper zone after inducement, essentially the first strong order flow zone that can act as support for price. After that, price corrects upward and tests the upper SMT block. From that area, we see a reaction downward. Many traders open short positions there, which is quite obvious in this situation. Then price moves down and sweeps an incomplete pullback. This is marked as number 2. As you can see, this sweep happens with an IFC candle, taking the liquidity with a wick. After that, we see the engulfing movement that forms the IFC candle itself, followed by an immediate retest. At this point, you could already enter a long position, placing the stop above the local high and targeting higher levels on the higher time frame. However, price then makes a small correction and removes inducement inside the IFC candle itself. Hopefully, you can see this clearly on the chart. That inducement is also taken with a wick. This is where I personally opened my long position. It was a very efficient entry that worked out well. After the entry, price moved upward strongly. If you look at the character of the move, it is very impulsive and clean. That tells us we read the structure correctly. We waited through the accumulation, manipulation, and distribution phases, and then used the most basic elements of the Nightstar strategy. Inducement sweep. Test of the zone of interest after inducement. Sweep of the incomplete pullback. Consideration of SMT blocks. And the retest of the IFC candle. All of that combined allowed us to execute a very clean and profitable position.